A scalpel in the hands of a surgeon saves lives. The same scalpel in the hands of someone who does not understand what they are doing causes irreversible damage. Debt works the same way. In the right hands, applied to the right purpose, at the right cost, debt accelerates wealth creation in ways that would be impossible without it. In the wrong hands, applied to the wrong purpose, at the wrong cost, debt is one of the most efficient wealth destruction machines ever created. Most people are never taught to tell the difference. They are either told debt is always dangerous and should be avoided entirely, or they are handed credit cards at 18 and left to figure out the consequences themselves. Neither produces good financial outcomes. Today we build the complete framework. 3 categories of debt. 3 completely different approaches. And the precise decision tools that tell you which category any debt you are carrying or considering falls into. Let us get into it. The first category is what I call destroyer debt. This is consumer debt, credit cards, buy now pay later schemes, personal loans for discretionary spending, auto loans on depreciating vehicles, payday loans. Debt that was used to purchase things that decline in value or disappear entirely, at interest rates that compound aggressively against you, with no corresponding asset on the other side generating income to service the cost. The mathematics of destroyer debt are genuinely brutal once you see them clearly. The average credit card charges between 20 and 26% annual interest. At 22% compounding monthly, a $5,000 balance paid at minimum payments takes over 20 years to clear and costs more than $11,000 in interest. You will have paid more than 3 times the original amount borrowed. The total cost of whatever you purchased with that $5,000 was not $5,000. It was $16,000. And that calculation does not even include the opportunity cost, the wealth that $5,000 could have built if it had been invested instead of spent, compounding at 7% annually over 20 years. Destroyer debt has 3 defining characteristics. The interest rate is high, above 7 or 8% in most environments. The thing purchased with it depreciates or is consumed. It has no remaining value after the debt is taken on. And there is no income generated to service it. Every dollar of the payment comes from your earned income rather than from the asset itself. The strategy for destroyer debt is simple but requires discipline. Eliminate it as the absolute highest financial priority before any other goal except employer-matched retirement contributions. Not because investing is a bad idea. Because you cannot build compounding wealth at 7 or 8% while paying compounding debt at 22%. The math runs against you every single month you carry it. The Avalanche method, paying minimums on all debt except the highest interest rate debt, and throwing every available dollar at that one, minimizes total interest paid and is the mathematically optimal approach. The Snowball method, paying off the smallest balance first regardless of interest rate to build psychological momentum, costs slightly more in total interest but produces faster wins that some people need to maintain motivation. Choose the one you will actually execute. An imperfect method executed consistently beats a perfect method abandoned. The second category is what I call builder debt. This is debt used to acquire assets that generate income exceeding the cost of the debt, that appreciate in value over time, or that increase your earning capacity in measurable ways. Mortgages on cash-flowing rental properties. Business loans that fund revenue-generating operations. Student loans that genuinely increase lifetime earning power in fields with strong employment outcomes. Builder debt has the opposite mathematical profile from destroyer debt. The interest rate is relatively low. The asset purchased appreciates or generates income. The income from the asset services the debt rather than the debt consuming your earned income. The rental property mortgage is the clearest example. You borrow at 5% to purchase a property generating 8% in net rental yield. The 2 percentage point positive spread means the debt is working in your favor. Every dollar of leveraged capital is producing more return than it costs. The property appreciates over time, building equity that multiplies your initial down payment. And the tenant's rent payment is servicing the debt, meaning someone else is building your equity for you every month. This is why financially sophisticated people carry significant debt while simultaneously building significant wealth. They have correctly categorized their debt as builder debt, as leverage that amplifies returns on assets they understand and that generate income to cover the cost of borrowing. The critical discipline in builder debt is the margin of safety. The income from the asset must genuinely, conservatively exceed the cost of the debt under realistic conditions including vacancies, maintenance, interest rate changes, and economic stress. Builder debt with a thin margin that depends on everything going right is not builder debt. It is destroyer debt wearing a productive disguise. Model your returns conservatively. Stress test the numbers. Ensure the margin is real. The third category is the most nuanced and the most misunderstood. I call it ambiguous debt. This is debt that most people categorize as good, but which is genuinely good only under specific conditions that most people never bother to verify. The primary residence mortgage is the most common example. Most people assume it is builder debt because property appreciates. But a primary residence is not a cash-flowing asset. It does not generate income to service the debt. Every mortgage payment comes from your earned income. The property may appreciate, but so does rented accommodation. And the true cost of home ownership when you account for property taxes, maintenance, insurance, opportunity cost of the down payment, and transaction costs is much higher than the mortgage payment alone. This does not mean buying a home is wrong. It means the decision is more nuanced than the simple narrative that buying is always better than renting. As we covered in episode 12, the right answer depends on your time horizon in the location, the price-to-rent ratio in your specific market, your career mobility needs, and your stage of life. The mortgage on a primary residence can be entirely justified as a forced savings vehicle, a lifestyle decision, and a long-term wealth builder, but it should be evaluated honestly rather than assumed to be automatically beneficial. Student loans are the other major ambiguous debt. They can be builder debt if the degree you are pursuing genuinely commands a salary premium large enough to justify the total cost of borrowing including interest, and if the career outcomes in your chosen field are reliable enough to make that premium predictable. Or they can be destroyer debt if the degree does not produce a material income premium, if the career outcomes are uncertain, or if the amount borrowed is so large relative to expected starting salary that repayment consumes income for decades without meaningful wealth building happening simultaneously. The framework for evaluating ambiguous debt is the same as for any investment. What is the total cost including interest over the full repayment period? What is the realistic return, income premium, property appreciation, or other measurable financial benefit? Does the return genuinely exceed the total cost in present value terms? And what is the margin of safety if the expected return does not fully materialize? Run those numbers honestly, not optimistically. Honestly. Let me close with the master framework that ties all three categories together into a single decision tool you can apply to any debt you are carrying or considering. Before taking on any debt, ask 4 questions in sequence. Question 1. What is the interest rate and how does it compare to the return I expect from the asset this debt is funding? If the return reliably exceeds the rate, this may be builder debt. If the rate exceeds any return, this is destroyer debt regardless of how the purchase is framed. Question 2. Does the asset funded by this debt generate income to service it, or does the payment come from my earned income? Asset service debt is fundamentally different from income service debt. The former builds wealth independently. The latter competes with saving and investing for your finite monthly cash flow. Question 3. What is my margin of safety if conditions change? Interest rates rise. Rental markets soften. Business revenues disappoint. A debt that only works in the best-case scenario is not builder debt. Builder debt must survive realistic stress scenarios. Question 4. What is the opportunity cost? Every dollar going to debt service is a dollar not compounding in an investment account. The true cost of any debt is not just the interest rate. It is the interest rate plus the foregone compounding on the capital tied up in repayment. Run every debt through these 4 questions. The answer to whether any specific debt belongs in the destroyer, builder, or ambiguous category will become clear. Debt is not your enemy. Ignorance about debt is your enemy. Now you have the framework. Use it. This is SERA Finance. Episode 14 is done. Episode 15 is coming, and we are going into the world of inflation. What it actually is, how it actually erodes wealth in ways most people never track, which assets protect you from it and which ones accelerate the damage, and why the conventional wisdom on inflation protection is incomplete in ways that matter. Subscribe. Turn on notifications. Smart money. Real talk.